You have made it to the basics or through the basics, but now we will get deeper into the process and our strategy, or the way we base our financial trading decisions on. And a big part of this is the volume profile. So this series will be about the volume profile mastery and a part of our strategy and process, or the way we analyze. So it's series 400, everything about the volume profile. You will learn in this module why our trading style is kind of unique. We, yes, use completely public tools, but we haven't seen anybody analyzing the same way we did now. If you do so, please, you're open to send them over to us, because I think there are very rare things in the world that are really, really unique, but we haven't seen anybody analyzing or trading the same way we do. What the volume profile itself is: an intraday trading strategy, different setups. We will go deep into examples and also watch it or go through examples on the markets. Then the big picture of the volume profile, the entry and exit signals, and what are some small helps in there. Some practical examples of intraday trading. So in the beginning we will explain you the models, the ideal setups, but of course not every day is ideal. There's still a discretionary part in it, so every day is different, but you will first learn the setups and then we will go through some examples. And the stability of the market within a value zone. We already talked about the Gaussian curve, or the value area, in earlier models, and we will dive deeper into that in here. Why our trading style, in our opinion, is unique. Why is it? One of the most important things is that you can trade or analyze the way and make trading decisions based on our process in all market phases. So you don't rely on long only, so expanding economies. You don't rely on short only. You trade long and short, but it's also okay if nothing happens. Of course, the market has to move a little bit, but you don't need extreme situations. You can trade long, you can trade short, but you can also trade balanced markets. We have a very good risk to reward. So it's not about like in HFTs where the risk to reward can be kind of small, but the hit rate very high. We tend to use and analyze and make trading decisions based on a risk to reward that is way bigger than 1. But for that, the hit rate is lower, but it's our trading style. But we have a good risk to reward. The take profit and the stop loss is determined before entering a trade. This is not in all the strategies that way, but it is with ours, or with the one of us, and we are acting in the direction of the big money. So we don't try to move the markets, we just try to find the big money and follow them and get like a small piece of the cake. The generation of profits mainly takes place in normal market phases. Yes, we can also trade unusual market conditions, but most of the profits are made in just basic market conditions. So markets rising, markets falling, but no special war situations, no crisis, no COVID, nothing, just regular market phases. And so, like I said, we don't need extreme situations for trading, and we don't use conventional indicators. So we don't use a MACD, we don't rely on moving averages. We sometimes use the VWAP, but that's it. So we just use market information, price information, and no special indicators. And our system can be used in any liquid future markets. That's the assets we trade mainly. And we have an economical use of mental energy. So you have a process, and the process of deciding, for example, when you scalp, your mental energy is way more drained than when you intraday trade or swing trade, because you need to make more decisions and you need to re-evaluate the process more often, and this is reduced to the minimal in our approach. And the trade selection, because we have a criteria and we will also implement a checklist, which is not the final checklist, it's not like an algorithm, but it's a checklist you can orient. Like it's like the fundament, and you can always go through the same process. So let us continue with what is the volume profile. What is the volume profile? Volume profile mastery 402. The volume profile is a visual preparation of the connection between price levels and volume. It contains so-called profile peaks, which provide us information about the price ranges where a lot of volume was traded in relation to the predetermined analysis period. So you define a period, and you create a volume profile out of this, or based on information in that period. And there you can see profile peaks and refer to them in the future as mountains, or in the following. The volume profile changes if you change the window or the time horizon you want to analyze. So if you increase the time horizon, of course, the zones of important value change, or the valleys and the mountains change. But the bigger the time frame, the more important those informations or mountains and valleys are. Resistances and support lines can be read and drawn into the chart based on the volume profile, and the illustration provides information about where the fair price is, because we already told that several times. There's the value area, there is the first standard deviation of the volume that is traded in the period you analyze. Most of the times you will take a daily or a weekly profile, and based on that you can see more easily where is the fair price, where do market participants agree and act on a price and trade a lot. So let us go through an example or a example. If you have price, and this is the previous week's value or profile, so this is the previous days or weeks value area, it doesn't matter, it can be any time period, and price is opening somewhere. We think, or we plan, that price is outside, and as soon as the price starts to accept the value area, which you can see here, which is the value area low, we plan that the price will move to the POC. So let us extend the POC. This is the previous day. So we have a new session, we have a new day. This is the POC, and we have a value area high and the value area low. So when the price enters the value area of a previous session, we plan that we have a reaction at the POC. Maybe we spent there some time, maybe we have a hard reaction. Then we will go down to the value area, and then we will start to trade through the whole value area. Same thing happens from the opposite side. So if price is outside and steps into a previous value area, or does not need to be a value area, can just be a high volume area or cluster, and spends time in that value area, we will plan with a reaction at the POC or VPOC, so because it's the volume point of control, and then trading back to the side of the value area they entered, and then trading through the whole high volume cluster. Those are the basics about this, but let us quickly revive the things we already told you. In a profile like this, we have a POC, point of control, but we define this as the VPOC because we have a POC also in the market profile, and in market profile we call it POC, in this we call it VPOC. Very often it happens that we also name the VPOC POC because it's more short, although it's just one letter, but officially this one is the VPOC. We have a value area high, which is the first standard deviation of the profile you're looking at. To the upside, a value area low is the same to the downside, and we have a low volume node, which is referred to this low volume area. Can be any low volume area. There can be also several low volume areas. We refer them, or the official name is low volume area, but we name them as valleys because we have mountains and valleys. I think this makes sense, a lot of sense. We also have an absolute high and an absolute low, which is the absolute high and absolute low of the range we are viewing or analyzing, or the profile is about. So absolute high of the day or of the week, or can, as I said, can be any time frame. Usually you just have a chart like this, can be a line or Japanese candlestick chart, it doesn't matter, but it's way more difficult if you have a chart like this to see where the most volume is traded, where most market participants agreed on a price or a price level or several price levels or an area. Yes, you can read all the information out of that, but it is way easier if you use a volume profile or a market profile or a combination of both. This could be an example chart or line chart matching to this volume profile. Important to know is that when the price is outside of a value area, it always, or most of the times, in a price point like this, we left the fair value area. Price is seeking to look for another fair area. So it changes or switches more to price discovery. Either we have a fundamental shift or the perceived value, the future perceived value of market participants is different now. So prices move, but at some point they want to have a fair price again. So most market participants agree on that and trade on that price level. When we are in price discovery and we go back into a value area, we plan, and the highest likelihood is that we will trade through that whole value area or high volume cluster. And most of the times there will be a reaction at the POC. So this could be another naked volume profile. We have the absolute low, we have the absolute high, we have the value area high, we have the value area low, and we have a POC. Profiles can look very different. We have a low volume area or valley here. We have one mountain here, we have another mountain here, and here we kind of have a low volume area, but we don't view this as a low volume area because it is at the extreme of the session we are looking at. We want values or low volume areas in between mountains or high volume areas. Let us go through a quick example. When you have multiple profiles, it doesn't matter if days, weeks, months, years, or even just 5 minutes, and those are secondly candles, it doesn't matter. You have value areas, and at some price points you will have an overlay of multiple important or interesting price levels. So for example, from this profile we have a low volume node here. Some people call this also imbalance, we call it low volume node or valley. We have a value area high of the following day and another value area high of the third following day. So we have multiple important levels on here. So in the future, this can be a very interesting level for us. So we can just draw a line in our chart, or we can extend the untouched or naked value area highs or POCs to the right. In most charting software this is possible, and we very often do this. But then there was a fundamental shift, whatever, there was a gap, and price went from this balance phase. As you can see, we have a big sideways range. We went into price discovery, and at some point market, as always, tries to find another fair value, so created another value area, and the market started to range, because a market does not trend forever and is not forever in price discovery. Then tried to continue with price discovery, but this price discovery failed, and we stepped back into the previous day's value area, got some reaction at the POC, went to the value area low, and then accepted the value area before we tried another price discovery and then traded through the previous day's value area. Then we started at the following day. This is a very interesting, kind of an interesting example. We had some acceptance at the high of the value area, so we spent a lot of time there and also created volume at the high of the previous day's value area. And then at some point we went again into price discovery mode and touched exactly the important level from the past. So the low volume node and the 2 value areas highs. There was price discovery. So if we would have entered the trade, we should take profits here, or we should look at the charts and look for short areas here, because we have falling value areas. So market participants are agreeing on a lower price. Either there is more supply or less demand, but value areas are falling. Most likely we are in a downtrend, so we can look for short opportunities over here and check if we can continue downwards. Furthermore, we established a new value area on the low, and now we are in price discovery. We are doing a retest, and we could look for a short opportunity here. But what setups we are looking for, we will dive deeper into that in the following slides. But first, we will talk about some opening intraday strategies or variants or options of intraday trading strategies. So, intraday trading strategies. There are different options you can trade intraday, and we will go through them now. There are different trading variants with roadmaps for intraday trading depending on the open, but you always need liquidity, so try to use the cash sessions or just highly liquid assets. There are 4 different trading variants for day trading. These are explained in the following slides. So variant 1 is the opening of trading between the POC and the value area high and low. So in this case, it's the VPOC. So the market opens in the morning of the asset, or generally the cash session, between the POC and the value area high or the value area low. So you are in balance. You open in the previous day balance is the option of variant 1. Variant 2 is opening between value area absolute, so the absolute high, and the value area high or low. So you are in the profile of the previous day. As I said, we will go through visual examples in the following slides. So we are opening in the profile of the previous day, but not inside the value area. Variant 3 is we open completely outside of the previous day's profile and value area. And variant 4 is we are opening completely outside the previous day's profile and value area, but immediately entry the previous day's value area in the first trading minutes of this trading session. In order to assign the right trading variant, or the one that is matching the current situation, it is necessary for you to wait for the opening of the day of the respective instrument. It's different if you trade the S&P 500, so the ES future, or the FDAX in European markets or oil markets. All of them have different opening times. You need to research them, or we will post them in the Discord chat. But they change between summer and winter time, and they are publicly available on the internet. But you need to focus on them for the assets you want to trade. So now we continue with the summary or addition of entry and exit setups for the volume profile strategies. So the different opening strategies, the different variants. You just learned 4 of them. So let us continue with them. There are multiple levels to trade at a level of interest. The level of interest most of the time is the value area high or the value area low. And you can choose very defensive stop loss, but of course it's always interesting to increase the risk to reward, not always, but most of the times. And we will give you a brief overview about possible entry or exit options. So you can use inside bars or outside bars. For example, you can use engulfings for a sign of strength, or you can use the volume spike following an inside bar. So you have a big move, then you have an inside bar, and there is no real interest anymore as a reversal signal. So let me take the pen. It would look like this. You have a price movement. For example, you go to a value area high of the previous day. There is the POC, there is the value area low. This is our goal, and we look for a short setup here because we opened in the value area. We'll go high, and then we will have one big candle that will go to the value area, maybe with a small wick on the top and the bottom, and then we will create a very small inside bar. You can use this as a reversal sign, so we continue downwards. Or you can use engulfing, so you have an upwards structure, and then you have one big engulfing candle short, and you can enter here and then continue downwards. There are different possibilities. There are different things that work in the different markets best. You need to spend time in front of the charts, and of course we will also give you information in addition in the Discord chat, but you need to build a strategy for yourself, and that fits you because you need to trust the process. Those are the things you can use, and you can also use 1, 2, 3 patterns or the infinite 4 or higher lower trends. So you can also go to lower time frames and wait for a trend shift. It's also a very good sign, can be a very good sign. Or in addition, you use the order flow, but not everybody in the beginning wants to use order flow or order flow data because too much information can be also confusing, although it can be very valuable. If you look at order flow, for example, you look at finished auctions, unfinished auctions, or high or low volume areas in the footprint chart. We'll dive deeper into that, I think in series 600 or 700. Third step or possible option is that you just take partial profits. So when you are inside, for example, you take a partial profit at the POC, so you don't need to hold the trade through the whole trade idea or the whole trade plan. So now we will discuss the stability of a market within a value zone. So if we open outside of a value zone and we accept the previous profile, and at some point we are going to accept the previous value area range because we stay a long time in there, we will look for longs at the value area low with different or through different setups. But when we accept the value area and the market runs into a value area or a high volume cluster, our plan always is that it trades through the cluster completely, either from the top to the bottom or from the bottom to the top. Confirmation points or confirmation, you can consider that the market on a daily time frame should stay in that value area or high volume range for at least 30 minutes. What is the checklist for the daily planning? The following settings should be made when you trade, when you do analysis, when you prepare for your trading and your trading decision, your financial decisions. In the daily chart, there should be, or the daily chart should be loaded on the software you use with maximum backward data. So the maximum backward data that is possible to load there. Identify and then draw the mountains and the valleys we explained earlier. So you have mountains and you have valleys, and the mountains are the big. So if we have a profile that looks like this, profile that looks like this, we have valleys and we have mountains. So this is the mountain area and this is the valley area, for example. Then we have another mountain here. This is not really a valley or a low volume area. We have the next one down here. And when price enters there and accepts the price or accepts this high volume area, accepts this mountain, our plan is that the price trades through it. Same happens if the price accepts that high volume area from the top, it will also trade through it. So, but you need to analyze those things, for example, on the daily time frame and implement them on a 30-minute chart. So you need to transfer the mountains and the valleys to a 30-minute chart. So you have the data on there. From the higher time frame, you can also use the monthly valleys for the weekly chart, the weekly valleys or mountains for the daily chart. It doesn't matter which time periods, depending on the trading style, you will decide. On the 30-minute chart, you open with 50 days back to load. You will draw the value area high or low of the previous day. In most software you can just draw them automatically or extend them automatically if they are naked. And then you draw the POC or VPOC from the previous day. And after the start of trading, you create a plan for the intraday path and transfer it to the 30-minute chart. And if you want to do some exercise, just take this naked chart and try to repeat the options that we just went through. Just a quick break, so you can pause, you can make a screenshot, you can do it for yourself, or you can download exactly that file maybe next to the video. So we have different variants. We always extract support and resistances out of the profile. The most basic variant, because most of the time markets are in value, we open inside, we open between the value areas. Then we search for longs on the value area high or shorts on the value area high and longs on the value area low. Most of the time there will be a reaction at the POC. That is variant 1. Then we have variant or option 2. In option 2 we open between the value area and the absolute high or low. So we open in here or we open in here. And at some point we will start to accept the value area. And then, of course, again, we look for longs on the value area low, for shorts on the value area high. Again, there can be reactions, or most likely are reactions at the POC or VPOC. Option 3 is we open outside the previous profile range. And then we just assume that price will continue in the direction of the gap, because between the absolute of the previous day and our opening price there will be a gap, and we think, or our plan is, that price just continues in this direction. In variant 4, which is the last one, we open outside, but very fast we start accepting the previous profile, we wait for the acceptance of the value area, and then we will look for short trades, again reactions at the VPOC, and the same thing from the other side. We will accept previous profile, accept value area, and then continue upwards. That's understandable. Hope you had it right when you did that exercise. So let's go through example or variant 1. It is when you open inside the previous day. So this is the profile of the previous day, volume profile of the previous day. We have value area high, VPOC, value area low, absolute high. We open inside. So we are between value area high and POC in this example. And we accept the price, so there's not big price movement. We stay inside the balance of the previous trading session. We look for trades on the value area high in this case, because this is the first standard deviation. And then we look for a reaction. We watch out for setups. We'll go through those setups in the following slides. And then, as always, our plan is that the trade will go through the whole high volume cluster or value area. In this case, yes, of course, there can be reactions on the POC, and yes, it also can trade back to the value area high. It can also sometimes step outside, go to short price discovery, but no long, will not stay there for long, and then trade through the value area. This is simple explanations. We will go through examples in the markets, of course, they are more individual. The same can happen from the downside. So we open between value area low and POC. Same story, just the other way around. We look for long setups in this case. For example, you can look for P-shapes. You can look to in the order book or the footprint chart. In the following series, we will talk about that. And look for setups or in the candle patterns. And then you have a second confirmation, and then you will look to trade through the whole value area to the other side. Of course, again, there can be a reaction at the POC, and then we trade through it. All of that is possible. You should look that when the open is, we spend more than 30 minutes inside the value area. So it doesn't matter if you open between the POC and value area low or a VPOC and value area high, you should stay in there at least for 30 minutes. And then that is the confirmation that this value area is still accepted. So now we are at the chart, we are in the FDAX future in 10th of October, just finished. So we built a balanced day. So we have a classic or typical D profile, and now we wait or prepare for the next session. But for that, we need to wait for the open. Where is the open? In this case, the open is between the value area high and the VPOC. So we think that this balance is accepted, and that we will trade from value area high to value area low, or value area low to value area high. So those are the two price levels we are looking for trades. But first we need to stay in the value area range for more than 30 minutes. So first hour has passed, so we stayed in there. So the acceptance of the value area is very high. So we can also check smaller time frames if we find some setups on the value area low for long or on the value area high for short. Where will we go first? We are now at the value area low. We went quickly or shortly into price discovery, but now we can look for setups long. This was, by the way, the 8 o'clock or 8 a.m. market open. Now is the 9 a.m. market open. Depending on the volume, if there's above average volume at 8, you can also use the 8 a.m. open. Otherwise, you should wait for the 9 a.m. open. So now we try to trade the balance. So we look for a long trade on the bottom and check if the price moves to the upside. And yes, it does. First, it tests the bottom a second time, and then at some point it moves to the upside. So now at the upside of the previous day's value area, we will check for short trades. What will happen? We have a reaction at the value area high. We go into some price discovery, and we have the first closing above the value area high. So this is the first sign that we are going to go to price discovery, but it's spending a long time at the value area high. So it's the first sign that you can add the footprint or add the order book, but we will discuss that in later sections. And maybe look for long, but for now, it is still a short bias. We're looking for short trades. If there are short setups, we're going to take the short setups. So on the long setup on the bottom, we will take the stop loss above the maximum stop loss. That's the biggest one you can take, is the stop loss below the previous day low. But when we have a setup, for example, we have small P shapes, then of course we can minimize our risk or improve our risk to reward. But now we still look for short trades. What happens? Our short idea fails. Most likely we have been stopped out here because our max stop is on the previous day absolute high. Happens sometimes. You lose, it's part of trading. And now we can look or could check for a retest of the value area high, but this is one of the next setups we will go through. So now we have finished the first opening variant, but let us compromise or summarize the idea. You need to know the market is more or equal than 30 minutes within the value area of the previous day. It's likely that the value area will be traded through, like in the example we just went through, but you can also look for other examples. It happens very often. Of course, at some point price will go to price discovery again, like in the example. But our plan in this case always is that the value area will be traded through again of the previous day. Entry takes place at the value area high or low, depending, and the take profit is on the other side. The stop loss is the absolute high or low of the previous day from the profile or from the area we define the value area. So does not has to be the previous day, but it's day trading setups in this case, so it's most likely the previous day. Opening variant 2 is that the market opens between the absolute high of the previous day and the value area high, or opens between the value area low and the absolute low of the previous day. So we have opening here, or we have the opening here. Then when the market enters the value area very fast, either from the top or the bottom, and spends some time in there, we wait until the market trades to the VPOC of the profile and then continues to the open. From the upside also trades to the VPOC and then continues to the opening price. That is the second setup. There is take profit in this case, or entry. We're looking for entries in the POC area or VPOC area, and our take profit is the open of the day. So what are the things we have to look for? Can we assume that heading for the previous day VPOC? So if we open outside the previous value area, but inside the previous day range or previous profile range, the target is the opening of the day, and we look for setups at the VPOC. Stop loss is immediately or above the VPOC. We will have setups, smaller setups. For example, we can have B setups in this case here. We can also have P setups where we had a fade breakout, then break in and then trade short, but we prefer B setups in a short case. In this case, we will look for P setups in the long case. Either we have a breakdown, then back break in, but those information will be part of the following slides. You can also use different setups to confirm this here, for example, trend shifts, or a combination of inside bars or volume spike and then inside bar is a very good formation for a turnover or a reversal. It will be a combination of setups you will search on the small time frame and the big picture. Big picture in this case, not really, because we talk about time frame of a day, but you can apply it to any time frame. It is a combination that you have a plan what the price will do, and then you will try to optimize your performance by going to lower time frames and looking for setups and further confirmation. So let us go through a quick example for variant 2 as well. We have different value areas here. This can be a nice example, by the way, for later as well. But we have opening value areas, we have rising value areas in this case, and then we have kind of accepting and boring price actions with the previous profile. Now, the session is finished, and we look or wait for the open. What happens on the next day? The open is close inside, but most likely the volume, because the volume in this day is kind of low and the price action in this day has been kind of low. But we check for the value areas in this case, so we wait for the open at 9, and the open at 9 happens here. So at 9 a.m. the open is outside. So what do we look for? We just explained it. We will look for a price movement to the POC. Oh, we reach the POC, and then we will look for a long trade. We will go to smaller time frames, check the footprint, check the 1 minute, the 5 minute, or the 3 minute, and look for a long trade to trade back to the open in this case. So what happens? Price reacts at the POC and trades back to the open. Now we are out of the trade. Trade for the day is done, and we are finished. We can look for further setups, but for this setup in this opening variant or trading style and trading plan, it is completed. There is another variant or option, that is variant 3. So opening completely outside of the previous day value area, not value area, but outside the previous day or the session you look at, outside of the whole profile. So the opening is either below or above. Then what do we expect? We expect a very strong trending day. It can happen that we go back into the value area, but that's the next step. In this case, we are opening outside, and in this case, when the opening is outside, we stay for 30 minutes outside. We expect a very strong trending day in the direction of the gap. So what do we need to look for? The market no longer accepts the previous day value or fair price. So during the opening trading session, there is a very strong acceleration in the direction of the gap. Most likely there is a gap because in the previous day we only have been in this price range, and then there will be a gap because we're opening outside of that range. The target determination in this case is more complex. We need to view at the big pictures or load a lot of the previous days. You can load, for example, the previous 1000 days and then look for naked POCs or general interesting levels, high volume areas, low volume areas, all of that stuff, naked VPOCs or naked value areas, although naked VPOCs are way stronger than naked value areas. The stop loss will be between the value area high or low and the absolute high or low, so we will look to place a stop loss in between this range. The safest stop loss will be in the value area, because if the market tests the value area high and then rallies, we are still safe. But here again, we will go to lower time frames, look for different setups, and depending on those setups, we will decide the stop loss and try to increase our risk to reward. Let us look for an example, but I think in the previous example we already saw kind of example like this, or for that case. So, like I said in the previous example, we already have an existing example. So we have kind of nearly no price action in this case. But we have a value area, again we have kind of a D-shaped profile. But as always we wait for the open, because this session finished and the open is far, far, far away from the previous day value area. So what do we expect? We expect a rally in the direction of the gap. So either you take the 8 or the 9 AM opening in the example of DAX. It's going to be different for the different assets. So gold has different opening times than oil, than the S&P 500, and so on and so forth. But what most likely will happen is we will continue to rally in this direction, so we can go to the smaller time frame and check for long setups. And then we can or should look to the past. If there is a past price chart, there is no really important information in the history of this price chart. There is no naked POC. Maybe there is a naked POC. So we can think about a horizontal line there. Go back to our chart. So this could be our goal in this example. We have a naked POC from a previous profile, so we can look on the smaller time frames for setups and search for longs. And our goal will be the red line that I just have drawn into the chart. But our goal is that we continue to click in that direction, and exactly that happens. So our trade kind of is done for the day, but as you can see, we strongly continue with the trend. So now we finish with variant 4. the last one. So if the opening of a profile is completely outside of the previous day range, so either below or above, like we had in the previous example, but we instantly enter the previous profile. So either the value area, but it is enough that we enter the profile. But we will wait for the acceptance of the value area, either from the top side or the bottom side. We have another strategy, we have another plan for that case. If the market opens outside of the previous day profile, above or below, and then starts to accept the previous session's range and stays there for at least 30 minutes, it needs to stay in between the high and the low of the previous profile, then there is a very high probability that at some point we will accept the value area. So we'll step inside the value area, or at the value area, we will spend some time, we will build volume on the top side or the bottom side, and then we will trade through it. And our trading plan is according to that. Of course, again, there can be reactions at the VPOC as always, because this is one of the most important points of the previous day. But our trading plan is to trade from the bottom to the top or from the top to the bottom. We will search for an entry as always on the value area high or the value area low through a setup. We'll go through the setups in the next steps, and we'll place a stop loss between the value area high and the value area low and the absolute high. So again, either in this range or in this range. Of course, the closer the stop loss, the likelier it is that we will get stopped out, but also the closer the stop loss, the bigger the risk to reward will be, and the other way around. But we will have a higher hit rate if we put the stop above the absolute high or the absolute low. Depending on your personality, depending on your trading style, there is no golden way. You need to trust your trades, you need to trust your plan. So you need to combine this, but this is the plan and this is the logic and our approach in this case. So again, we will go through an example. So in this case, again, we have the FDAX. We are already closing outside the previous or of the day value area. So our bias is kind of short. We also have falling VPOCs and falling value areas, but we're closing outside and we are also opening at 8 AM outside. So we can also wait for the open at 9, but it will be outside very likely as well. We are building a range here, so our bias at first in the first step is we will continue short because we have an opening outside of the previous day's range. We can search for short setups. In this case, maybe we get stopped out, maybe we get a break even, we don't know. But at some point we are entering the previous profile again, so this close is inside, and then we spend more than 30 minutes inside the previous profile, so we are accepting the previous profile again. And now we are also accepting the previous value area. So now we can start to look at long trades, because if we extend the previous value area, we have this area of interest, we have this area of interest, and this area of interest. So we can now start to look at long setups on the value area low of the previous day. So in the lower time frames, most likely we will get a setup there, and then we have a first reaction at the POC. We can, if we go down, look for another long setup, and now we will most likely trade through the whole value area. So what happens until the end of the day? So yes, at the end of the day, we did not reach it completely, but the strategy or the plan we create is not about getting tick entries or to the exact tick entries and exit. It is about in general making profit and in general understanding the logic and then perfecting that logic with different setups. But the setup is we opened outside. First, maybe we got a stop loss because our first expectation or plan was that we'll continue downwards. We stepped back into the previous profile. We accepted this profile for a while. We accepted the value area. We have been in the value area. The first aggressive long would have been here. The second option for a long is here. and then we trade through it. And if we want to trade or stop our trade earlier, there is no problem with taking partials on the way. You don't need to hold it to the complete end. So another example, and we finished through all 4 options with opening options and intraday trading strategies. So we continue now with some more examples. .404 Volume Profile Mastery. It is about the big picture now, and taking the big picture into account, you now got to know the models of the 4 trading variants you can implement in intraday trading or in day trading, but you can kind of apply the same logic to any time frame. We'll talk about this in the following. So in the big picture, you will have a volume profile of any viewed or analyzed time period. And there are going to be mountains and there are going to be valleys. The mountains and valleys give us information about the resistance and the support levels. And the bigger or the smaller the valley is, so the bigger the mountain or the smaller the valley, the stronger the information or the value of that one is. The resistance and support zones come from the bigger picture, and then they are transferred to smaller time frames. So when you analyze on a monthly, you can take the data and implement it into your weekly or daily chart, and then look for a setup on the smaller time frames, so you increase your risk to reward. The bigger the time frame, the bigger or the more value the information has. The bigger picture provides then or information about the big trend and the direction of the trading asset or trading instrument. So trading through the daily profile, it is the same like we just had. There are different phases. So if the market runs into a high volume area, it is like the value area of the previous day, but it can be any high volume area of a profile. It is likely to trade through it. So if it enters this high volume profile here, and it enters and it reaches the POC, it is likely to trade through that high volume profile to the next low volume node, so to the next valley. It will accept this mountain, cross this mountain, and go to the next valley. The market heads for the VPOC, in this case, then trades back to the lower area of the volume cluster, high volume cluster of the mountain, and then trade through it. Afterwards, there will be an acceleration and negotiation of the whole cluster. So it just passed the whole cluster, so we are in the next valley, and it can continue to accept the mountain or cross the mountain again and just continue with balance, but very often it steps to the next mountain, and then it either remains in this range, like I said, and continue there for a long time, or will continue, leave the cluster and search for the new cluster, or try to accept the new cluster, and is traded to that completely again. So of this cluster you have a volume POC here, and of this cluster you have a volume POC here. So you can have one profile, you have multiple POCs. Of course there is only one maximum point or one price level where the maximum volume is traded, so there's officially just one VPOC, but for explanation, we just now use that there are multiple high volume areas, multiple mountain tops, multiple VPOCs. There will be reactions, but when it enters another mountain, another high volume area, most likely it will trade through it again, the same logic we explained you now several times. So neutral zones usually have to be like resistances. So neutral zones are the zones in between the low volume areas, and there are no interest in leaving such a volume cluster if the level nevertheless is broken after a subsequent pullback. A strong acceleration is accepted if it accepts a new level. Sometimes it also happens that it fills up the low volume area, but the first plan and the first logic is always that we'll trade through the next mountain. So let's take another example. We just took a stock. I think it's Booking.com, Booking Holdings. Yes, Booking Holdings listed on the Nasdaq. We have a couple of mountains here. So we have a mountain here. We also have a mountain down there, but those mountains down here do not really matter that much because price is further up. So what are we looking at? If price is currently at the state, we can mark our mountain. And I think in this case, I will choose this whole area as a mountain. Yes, you can choose this as a small valley. There is no problem in that, but my personal preference, I would choose this as a mountain, and then I have my valleys down here and down there. So this is my high volume cluster, and I will check for price development, and I will look for, so we have been outside of the high volume cluster, out of the mountain. We're back inside, so I will check for short trades down here. Because we're now back inside, we'll check for a reaction on the VPOC, but I will not trade it, but most likely there will be a reaction. And I will look for long trades from the valley, from the downside. So if we step inside the valley and back inside, I will look for long trades. We can check what happens in the future because we can just continue with the chart. We had a big gap, we are outside, we accepted back inside. So we closed inside with this candle, and now we can look for long setups, trade through the mountain. Oh, what happens? We traded through the mountain. As I said, you can also take this valley as one, then your take profit would have been earlier. And then we look for short trades on the upside. So we tried to go to price discovery, but price slowed down. Go to lower time frames, look for a setup, and now we're looking for the stock to get short again. Most likely there will be a reaction if we reach the POC. There will be a reaction over here. What happens? Price will not continue down. It goes up and goes into price discovery. And then at some point, if we break the previous high, we have a continuous uptrend, and then we can look for long setups. What happens with the stock? It continues long. So yes, there are of course going to be failures. So maybe you would have gotten an entry here on a low time frame, and then you got subbed out. But again, it is part of trading. You can do nothing about that. But take some different charts, take your stocks, take futures, take currencies, and exercise. Let us go through an example. We took the oil future and we make an example analysis of a big picture. So you are not only focusing on day trading, but you can also implement the same logics to the big picture. We have a volume profile to the left. We can increase the size of that one a little bit. Let's increase this to 30 so it's bigger. So we have an area, or we have a mountain. Where is the biggest mountain? Price currently is at the VPOC level, so we have this one. But where are the next valleys? We have a small valley down here, and we have a small valley down here. We have another valley here and another valley here. Of course, this is kind of a beautiful D shape. There are more complex shape, but you need to learn to identify the valleys. Of course, this valley is way more powerful than this valley currently, but the price is here, and we're looking for the next areas of interest to trade. So we can create kind of a zone in here because this is our mountain and there is our valley. We can mark our first valley here. It is on the top side. Another valley down here, and we can use or mark the VPOC of the profile. Just make it red. No, we don't want texts. We want to make it thick and big. So, and now we have interesting zones from the bigger picture to trade off, because now we are at the POC, either we go down and we look for long trades to trade through the value area or the high volume cluster, or we will look for down trades on the upside and trade downwards. And it does not matter. We will have a reaction at the POC, maybe go upstairs, maybe look for a second chance and trade again through the value area. So we have a plan. It is a simple or very simple implementation of the things you just learned. Try to take different charts, try to exercise, maybe send them in the Discord chat so you can get some feedback on that, or just try to exercise, make analysis, and then check before, after, take some screenshots, take some notes, and check if the analysis is going well or not.